discuss the rise of the interest rate, inflation, and how to be prepared, we have Jason Mercer, Chief Market Analyst and Director from the Toronto Real Estate Board. Hello, Jason, and welcome.
Thanks for having me.
So thank you for being on the show. And to begin, have you been surprised about the rise of the interest rate?
No, I mean, when we were forecasting, even at the beginning of the year, our outlook came out at the beginning of February. We had anticipated some form of impact from rising borrowing costs. We'd actually started to see fixed rate mortgage products start to trend upwards even before the new year, and the anticipation is that would continue and even accelerate as the Bank of Canada started to move like they did in March. I think the only thing that was perhaps unanticipated was the degree to which the Bank of Canada would raise rates and how quickly they would do so. And so I think that certainly caught some people by surprise and led to a little bit more uncertainty in the market than we otherwise would have seen.
Yes, as some people call it, speculation. So that caused a definite problem within the housing market. But what does the rise of the interest rate mean for the people, essentially? Because people hear this term, the media talks about it, it's written about, but what does it really mean for the people? Can you put it in layman terms for us?
Sure. So, I mean, if you think about people who were set on purchasing a home in 2022, a lot of those individuals have moved to the sidelines. And that's not to say that they don't intend on purchasing a home as we move forward, but they have to recalibrate a little bit. And that recalibration could include things like thinking about a different home type, one that comes in at a lower price point. So for example, if you're thinking about buying a detached home, maybe now you're looking at a semi or a townhome, lower price point, it mitigates the impact, at least to a certain degree, of higher borrowing costs. On top of that, you may have some households that are looking, say, further afield, changing the geography within which they're going to purchase a home. Again, that could lead to, say, a lower price point and being able to get the type of home you want to purchase, but at that lower price point, or some combination thereof. But that decision-making process takes time. And so, if you look back the past interest rate tightening cycles, it can take about 18 months for that full impact of increasing borrowing costs to have sort of play itself out in the marketplace. But a lot of the people who are on the sidelines today will eventually move back into the marketplace. Now, another impact, of course, has been on the pricing front. So when interest rates increase, one of the relief valves, I guess you could say, is price. And so if you don't see as aggressive offers, that's because people are now looking to mitigate the impact of those higher borrowing costs. Because in reality, the great majority of home buyers in Canada are purchasing with the use of a mortgage. And so they're thinking more about monthly payments rather than the actual purchasing price. And so you'll see a lot of people start to make offers that make sense relative to what they can afford on a monthly basis. And we've seen that over the past number of months. We've seen the average selling price go from over $1.3 million in February down to around, say, 1.08 over the last couple of months.
Yes, I think what's really happening is, and even the people who are talking to their, if they're interested in buying a home, it's just not just talk. It's talking about what's my affordability, and whether they have a broker, a real estate agent, or a bank representative, they're starting to tell them logistics, saying okay, this is what we can do, even if we extend a mortgage to 30 years. What really is going to happen here is this is what your monthly take is. And then you have to factor in all the other costs. And can you afford that? And I think that's, like you said, it's what really people are looking at. But can you explain the process of why interest rates go up and down? 30
Sure.
seconds, just to make it short and sweet for the viewers.
Yeah, I mean, in terms of the Bank of Canada's perspective, their whole focus is inflation. So we've heard a lot about inflation over the past number of months, but essentially what that's looking at is sort of that sort of basket or group of consumer goods and services that your average household is purchasing, say, on a month in, month out basis. And we've seen a real acceleration in the year over year price of those goods and services. We've been 6, 7, close to 8% in terms of that inflation, whereas over the long term, the Bank of Canada would like to see prices rising in around the 2% range. And so how do they throttle that? Well, they start to raise their overnight rate. That's their sort of policy rate, with the hope that higher borrowing costs will cause your average household to pull back on their spending a little bit. So there'll be less demand for those products, and you'll start to see price growth ebb.